What if I told you there's a simple way to invest in the stock market that has historically provided strong returns, survived multiple crashes, and built wealth for millions of people? That's exactly what the S&P 500 offers. But how do you actually invest in it? Where do you start? What are the risks? And how can you maximize your returns? In this video, I'll take you through a complete step-by-step guide to investing in the S&P 500, even if you're a complete beginner. Before we dive in, make sure to like this video and subscribe to Investosphere for more in-depth finance and investing tips. Number 1. What is the S&P 500? The S&P 500 is an index that tracks the 500 largest publicly traded companies in the United States. It includes companies from various industries, providing instant diversification. Historically, it has delivered an average annual return of about 8 to 10% over the long term. If you had invested $1,000 in the S&P 500 20 years ago, your money would have grown significantly. Question: did you know that Warren Buffett recommends the S&P 500 for most investors? Why do you think even billionaires trust it? 2. Why should you invest in the S&P 500? Diversification. Since it includes 500 companies, it reduces the risk compared to investing in individual stocks. Low risk, high returns. Over time, the S&P 500 has outperformed most actively managed funds. Compounding growth, reinvesting dividends, and adding more over time allows your investment to multiply significantly. Inflation protection. The stock market historically grows faster than inflation, preserving and growing your purchasing power. Question: if you could own a piece of any company in the S&P 500, which one would it be and why? Apple, Tesla, Microsoft? Let me know in the comments. 3. How to invest in the S&P 500 step by step. Step 1. Choose a brokerage account: Fidelity, Vanguard, Charles Schwab, Robinhood, or others. Step 2. Select an S&P 500 ETF SPY, VOO, or IVV. These funds track the S&P 500 and allow you to invest in all 500 companies at once. Step 3. Set up automatic investments. Many investors follow the dollar cost averaging strategy, which means investing a fixed amount regularly instead of all at once. Question: have you ever invested in the stock market before? If yes, what was your first investment? If not, what's stopping you? 4. Common mistakes to avoid. Investing all at once instead of dollar cost averaging, which helps reduce risk. Selling in a panic during a market downturn instead of holding long-term. Ignoring dividend reinvestment, which significantly boosts long-term gains. Trying to time a market instead of staying consistent with investments. Question: would you be able to hold your investments during a market crash, or would the fear of losing money make you sell? Let's discuss in the comments. 5. How much should you invest? Start with what you can afford, whether it's $50, $100, or $500 per month. The power of compounding. Investing just $100 per month in the S&P 500 could grow to over $200,000 in 30 years. If your employer offers a 401k plan with S&P 500 index funds, you should take advantage of it. Question: if you started investing today, how much would you be willing to put into the S&P 500 each month? $50? $100? $500? Comment below. And there you have it. A complete step-by-step guide to investing in the S&P 500. Whether you're just starting or looking to refine your strategy, this is one of the simplest and most effective ways to build long-term wealth. If you found this helpful, make sure to like this video, subscribe to Investosphere, and comment below if you have any questions. Your financial future starts today. See you in the next video.